Investors liking what they're seeing with Citi as well, announcing payouts, looking at dividends increasing by 41% to 45 cents, announcing a $17.6 billion buyback after, of course, the results from the Fed today. Also, Huntington Bank shares raising its dividend by 27% to 14 cents and announcing a $1.07 billion buyback program. We'll continue to monitor these as they come over the wire, guys.
Leslie, thanks for that. So if we're looking at 45 cents per share dividend, the consensus was for about 40 and 17.6 buyback. The consensus was about 16.3 for Citi. So that's probably why you're seeing 0.8% or so after hours move in that stock. Bill, I mean, overall, we were talking about, could this be a catalyst for the broader set of banks? Clearly it is today, right now, with Citi, because it's done what everyone expected, boost payout. But there are a couple of those other ones that we've been talking about that sort of weigh down on the broader sector.
There's another long-term dynamic that Mike and I were talking about upstairs, and that is these banks were the most hated stocks from the bottom in 2009 until Trump got elected a year ago in November. And so they had a fantastic run from the day before election in 2016 to the end of January, and they've been in a correction. The correction comes because too many people piled on all the value guys. It was the only way to make money for the value guys and gals, and the hedge fund guys were all piling in there. And so it takes time to correct the excess of temporary enthusiasm, but these statistics that we're seeing today are a sign that the health of the organizations over the next 3 to 5 years is good, and there's a bright future if the United States economy is strong.
Leslie, you've got another one for us as well? Maybe not. We'll come back to Leslie. No, Leslie Scott. Go for it, Leslie.
Hey, guys, that's right. We've got a news release from JPMorgan to raise its dividend by 43% to 80 cents a share. They're also announcing a $20.7 billion buyback program. Also, American Express raising its dividend by 11% to 39 cents a share, announcing a $3.4 billion buyback program, guys.
Leslie, thanks very much. So for JPMorgan,
about a 3% dividend yield
yeah,
at the current stock price. Citigroup's new dividend gets it to about a 2.6, 2.7% yield before these after-hours moves. So it's nudging it back up to a above broad market dividend yield.
That was a lot more than JPMorgan, I think, had predicted.
It was on the dividend, the buyback fractionally below. So a little bit of.
Jamie Dimon hinted that, at the higher prices, he wasn't going to be as anxious to buy the stock. Right. But he came through with a lot of cash return. Yeah. So it makes his $34.50 that he paid right after the whale trade in 12 and the $53 that he did on the Jamie Dimon bottom. He's getting a lot better dividends.
David, these numbers, excuse me, Stephanie, momentarily. David, these numbers we're seeing coming through in terms of Citi, JPMorgan's yields, does it put to bed the fears from Goldman Sachs and Morgan Stanley?
Well, I think it just shows the industry is healthy, and they have a lot to pay out. I think this is the Goldman thing will be resolved, the Morgan thing will be resolved. It doesn't need to be done in public like this. It's sort of like high school never ended or something. But at the end of the day, the companies are healthy. That's why the economy is healthy, and I think one is leading the other. I think the banks, and I come back to my comment before about, is this something that has been good or bad for the economy since 2008? Meaning the Fed came in, basically quasi-nationalized these companies. They continue to do it. It's helping the economy. It's keeping Wall Street open. It's keeping rates generally low. Money is flowing. Unemployment, and because of that, I think unemployment is low and the market's doing well. And so, I think it's helped. I think we just have a tremendous amount of fear now in these stocks and in the market about rates and trade and all this other stuff. But that will all get sorted out. In the meantime, there's nothing like making a lot of money and paying a nice dividend.
Yeah, Anton, I mean, going into this, Citigroup was seen as one potential that would have the most upside. Is that how you're seeing it so far?
Well, clearly, I mean, it's been maligned, it's been beaten, it's been down a lot year to date on a lot of their exposures around the world. But they prove they've got a lot of capital, and the stock is cheap. It's cheaper than it was going into their analyst day last year. So I think there's a fair bit of upside in Citi, and I think there's a whole lot of upside in the group. The group was down 13 days in a row, and it's never happened before in the history. Even during the crisis, it didn't do this. So, I mean, what a great time to be a bank.
Well, I mean, are those concerns valid? When you're looking at the yield curve flattening to levels we haven't seen in years, I mean, that's a direct hit to profitability in terms of the outlook.
It isn't, because I think that everybody's looking at this 2 to 10 spread, and banks don't fund off of 2 years. And most banks are going to report higher earnings for the quarter. And you're also extrapolating this yield curve that's going to stay here forever. And we've got externalities like pension plans, defined pension plans that have to buy bonds before the end of September during the tax cut. That's putting pressure on yields. I expect yields to normalize. I think the Fed's going to take rates up. I think the economy's good, strong GDP, and lots of capital in the banking system. And M&A is about to be turned loose with less regulation. So a very good time to own the banks.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.